have Mr. Ram Mohan Rao, the MD and CEO at SBI Card, joining us to talk to us about their earnings, because the revenue from operations was up 32% and quarter on quarter the profitability is also higher by 17%. While the operational metrics look quite decent, sir, just wanted to get a sense as far as your credit cost is concerned. That's gone up by 77 basis point quarter on quarter. Understandably, of course, there has been an up move overall with respect to the rate hikes, but could you explain to us what we should expect in cost of funds going forward?
Credit costs, if we look at entire FY23, it stood at 5.9%, which is a 230 basis point improvement over the previous year. Having said that, but Q4 had a different trajectory where we ended with a credit cost of 6.3%. We carried out a kind of one-time adjustment to the model estimates, which elevated the credit cost during Q4 by 20 basis points. Adjusting for that, it will be like a 6.1%, which is broadly in the range of 5.8 to 6.2%, which we always guided in the past. We identified a small segment of portfolio, particularly from the legacy portfolio, which was showing higher delinquencies. We have initiated portfolio actions to reduce the kind of flow rates and also improve the write-off kind of performance. So these actions will be showing the result in the days to come. But the vintage, or the latest vintage, or the sourcing what we have done since 2020, it's holding good. It is behaving as per the expectations in terms of delinquency. So the actions initiated by us will start showing the result after a quarter.
All right. Good to have you on board. Thanks so much for joining in. I just want to know the outlook on credit costs. Where are they likely to trend, and where do you think that we could see it trending towards the lower end of your guidance?
So normalizing it for this one-time adjustment, it is at 6.1% for Q4, which is broadly in line with the 5.8 to 6.2% what we have guided in the past. We analyzed the problem at our end. We looked at which segments of portfolio are showing higher delinquency as compared to the portfolio average. We undertook a lot of portfolio actions on this portfolio. It will take a quarter to start for the credit cost to start declining. But we will continue to operate in this tight band of 5.8 to 6.2%, maybe at the upper end of this band for a quarter before we start actually showing a improved credit cost performance.
Okay, and is the higher cost attributed to older customers or the customers acquired post-2021?
The vintages, latest vintages are what we call the sourcing done from the COVID period is behaving normally as per our expectations in terms of the standard delinquency kind of a band what we used to observe. The problem is with a small segment of the portfolio from legacy, that means pre-COVID period. So we identified, we sized up the problem, we initiated actions. These actions will start reflecting in the days to come.
And given that the industry has been seeing, the low revolver mix, can you tell us how that's looking like in terms of your credit costs? Will the mix start showing better results going forward?
At SBI Card, the revolver behavior is in tune with the industry broadly. We have been taking a number of steps to encourage or get a kind of customers who have a higher propensity to revolve. We are permitting higher share of self-employed, even new to credit card kind of customers who have a higher propensity to revolve. For the first time in this quarter, we have seen the revolver portfolio growth has been in tune with the general portfolio growth. That's the reason it's stabilized at 24%. It will be difficult to say what will be the trajectory, when will it improve. But in terms of taking steps that are required, we are taking right type of steps.
Sure, but even though your market share of cards, in force is rising, your growth of cards in force is not as quick as the spends growth. Is that a concern?
As you know, the spends is a play of both retail as well as the corporate card spends. During FY23, our retail spends have increased by 41% year on year at a very healthy rate. We have seen a kind of improvement across broad categories. Even the per card spends, retail spends have increased by 9%, despite the card base increasing by 22% during the year. So this is because of our constant efforts to improve the customer engagement and deliver a better customer experience. These are helping us to keep the retail spends at a healthy clip. But overall, market share is a function of both corporate card spends and retail spends. We guided in the past that corporate card spends is more of a top-line game. It will be less accretive to the bottom line. We want to play in this space in a calibrated way. We guided in the past that we would like to keep the corporate card spends in a narrow range of 22 to 25%. We continue to do so. While we will look for efforts to ramp up the spends, we will also be mindful of the bottom line impact. So the efforts what we have undertaken so far will help us in terms of slowly bridging the gap between the cards in force market share and the spends market share.
And at the end of the last quarter, you suggested that your net interest margins will improve. But given that the pressure continues, what's the outlook for FY24 on your net interest margins?
Last quarter, that is a March quarter, the cost of funds increased by 39 basis points. Predominantly, the funding happens through short-term working capital lines, what we avail from the banking system. 65% of the funding happens through the short-term liabilities, while 35% is funded through long-term liabilities. But we were able to transmit this rate increase largely in terms of new disbursals, which helped us actually absorb this cost of fund increase. So that's the reason we were able to maintain NIM at a stable rate of 11.5%, which is only 5 basis points lower than the previous quarter. We are confident for the kind of steps what we are taking in terms of transmitting the rate increase for new disbursals. We are confident that NIM will stabilize over the next 2 quarters.
Okay, on the cost side as well, the fees and commission expense has gone up quite sharply. What is causing this sharp rise, and will it continue in that direction going forward as well?
We talked about the robustness in the retail spends, which adds to the fee income or the interchange income. Similarly, increased corporate card spends will also add to the fee income. Particularly during the last year, from 1st of October, when the regulatory directions had some adverse impact on certain revenue lines, we found a couple of opportunities to partially supplement our fee income. We levied a fee on the rentals. We revised it again in the month of March. We increased the processing fee in respect of EMI transactions. All these have helped us to keep the share of fee income and the commission income at a robust level. So we are expecting a robustness in the spends to continue in the days to come. So will be the case with the fee and interchange income as well.
Okay, and give us a sense as to what the outlook is, given that there is now talk of credit through UPI. Will that really affect the business for SBI cards? Will this new revenue stream be built around this?
Industry already offers various products, particularly through the digital means. Banks and NBFCs offer unsecured loans, BNPL, etc. through digital means, completely end-to-end digital. Banks also offer debit card-based EMI programs. So that way, this is not a dramatic change, accepting the fact that it is a convenient way to avail the credit. So it's a better user experience, better way of availing credit, but it's not going to change the game dramatically in terms of competitive intensity.
Okay, so we'll let you go on that note. Thank you so much for making time and speaking with ET now. But time to